Next week, the private jets will descend on Davos. The global elite, the billionaires, the prime ministers, the tech moguls will land in their ivory tower to discuss the fate of the world. They'll sip champagne, shake hands, and talk about global cooperation. But just outside the security perimeter of the World Economic Forum, the locals are grinding their teeth. They aren't looking at the elites with awe, they're looking at them with rage. To the average American or Brit, Switzerland is the ultimate safe haven. It's where you park your money when the world is burning. It's the land of chocolate, Rolexes, and political neutrality. It is the geopolitical bunker. But I'm here to tell you that the bunker is cracking. Right now, a political movement is sweeping through Switzerland that threatens to detonate the country's economic model from the inside out. It's not a war, it's not a recession, it's a demographic suicide pact. The Swiss are preparing to vote on a radical proposal, a hard cap on their population. No more than 10 million people. Period. If they hit that number, the borders shut. Agreements are torn up. The economy hits a brick wall. Why does this matter to a guy sitting in New York, London, or Toronto? Because Switzerland is the gearbox of the global financial system. It manages $2.4 trillion in offshore wealth. It houses the headquarters of the companies that make your medicine, your food, and manage your retirement funds. If Switzerland pulls the plug on the global economy, we are looking at a Brexit on steroids. And if you hold the S&P 500, gold, or even just US dollars, the shockwaves from the Alps are going to hit your wallet harder than you think. Let's peel back the layers of the world's most expensive paradox. To understand why this is happening, you have to look past the postcard image of Zurich. Imagine you live in a house made of solid gold. It's beautiful, it's the envy of the neighborhood, and it's worth a fortune. But now, imagine that so many people want to visit your golden house that you can't get into your own bathroom. Your hallways are gridlocked. Your rent has tripled because everyone wants a piece of the floorboards. This is the reality for the average Swiss citizen in 2026. I was looking at the data, and the numbers are staggering. The Swiss population has been growing 5 times faster than the European Union over the last decade. Imagine if the population of Florida grew by 20% in 10 years while the infrastructure stayed exactly the same. That is the pressure cooker they are living in. About 27% of the people living in Switzerland right now aren't Swiss citizens. That is massive. For comparison, in the US, the foreign-born population is about 13 to 14%. Switzerland is running double the American rate. But here is the twist, and this is critical for understanding the resentment. We aren't just talking about refugees or low-skilled labor here. In the US, the immigration debate often centers on the southern border. In Switzerland, the resentment is directed upward. It's the high-end immigrant. It's the German banker, the French pharmaceutical researcher, the American tech developer. These are people earning 6 figures, driving up the cost of penthouses in Geneva and pricing the locals out of their own cities. Meet Angel Okaside. He's a 22-year-old nurse from Thun, a place that looks like it was drawn by Disney. He told reporters, "Our public transport and highways are at their capacity limits, the emergency rooms are overcrowded." You notice it in every area of life. Angel isn't some fringe anarchist. He's a qualified nurse, a young professional. And he's joined the Swiss People's Party, the right-wing juggernaut pushing that number 10 million Switzerland initiative. The proposal is blunt force trauma. If the population crosses 9.5 million, asylum seekers and family reunifications get blocked. If it hits 10 million? The nuclear option triggers. Switzerland would be forced to rip up its free movement treaties with the European Union. This is the golden cage dilemma. The Swiss people feel like their culture is eroding and their quality of life is plummeting because of their economic success. They are rich, but they feel miserable. And when a population feels miserable, they vote for drastic changes. Just ask the British about 2016. Before we talk about how this crashes your stock portfolio, we need a quick history lesson to understand the stakes. We tend to think of Switzerland as eternally rich. But until the late 19th century, it was a rocky, resource-poor backwater. They didn't have oil, they didn't have gold mines, and they didn't have a colonial empire. So, what was their biggest export? Mercenaries. Literally, their main business was sending young men to go die in other people's wars. Those colorful Swiss guards protecting the Pope at the Vatican? That's not a costume, it's a relic of when Switzerland was the Blackwater of the Renaissance. The transformation into the financial fortress we know today only happened in the 20th century. They used their neutrality and their mountains to shield capital while the rest of Europe blew itself up twice. Then came the corporate boom. Low taxes, high stability, and a highly educated workforce attracted the giants. This is where the wallet connection starts to kick in. Look at your portfolio. Do you own an international ETF? Do you own a total world stock market fund? Then you own Nestle. You own Roche. You own Novartis, UBS, Zurich Insurance, Richemont. These aren't just Swiss companies, they are global titans. And here is the dirty little secret of their success: they are addicted to foreign labor. Stefan Legge, a top economist at the University of St. Gallen, put it bluntly, let's not kid ourselves, immigration is the sine qua non of this economic success. Sine qua non. That's Latin for, without this, nothing exists. The watches, the finance, the pharma, they run on imported brains. Roche, the pharma giant, employs 15,000 people in Switzerland from 120 different nations. If you cut off the flow of talent to these companies, you are severing the fuel line to the engine. The SVP, the party pushing this population cap, has a history of winning on emotional narratives. In 2007, they ran a poster campaign showing white sheep kicking a black sheep off a Swiss flag. In 2009, they banned minarets. They know how to tap into the fear of the other. But this time, the other isn't just a cultural threat. The other is the senior vice president of risk management at UBS. The other is the lead oncologist at Roche. If the voters kick them out, who is going to run the bank? Here is the mechanism that turns this from a local political squabble into a global economic nightmare. Switzerland is not in the EU, but it has a series of bilateral treaties that give it access to the single market. It's a best of both worlds deal. They sell to Europe without being ruled by Brussels. But there is a catch. It's called the Guillotine Clause. These treaties are linked. If you break one, they all fall. The most important one is the free movement of people. If the Swiss vote to cap their population at 10 million, they are legally forcing their government to violate the Free Movement Treaty. If that treaty is violated, the EU has made it crystal clear, the guillotine drops. Access to the European market is cut off. This is the Brexit scenario, but potentially faster and more brutal. When the UK left the EU, they had years of agonizing negotiations. The Swiss mechanism is more like a trapdoor. Opponents call this the chaos initiative, and for good reason. UBS CEO Sergio Ermotti, one of the most powerful bankers on the planet, went on record this week. He tried to be diplomatic, saying we must take public concerns seriously, but he also warned that the country must remain open to skilled workers. Translation: please don't do this, you are going to ruin us. Business lobbies like Economy Suisse are screaming from the rooftops. They know that if Switzerland loses access to the EU labor pool and market, three things happen immediately. 1. Capital flight, multinational HQs will leave. Why stay in Zurich with high costs and no talent access when you can move to Singapore, Dubai, or even Austin, Texas? 2. Currency volatility, the Swiss franc is currently overvalued. If the economy stumbles, the central bank might lose control. 3. Inflation, if you cut off the supply of workers, wages skyrocket. That sounds great for the worker until a burger costs $45 because the restaurant can't find staff. But here is the scary part, the voters might not care. A December poll showed nearly half the electorate supports the cap. Young, old, rural, urban, the frustration is universal. They are willing to trade economic growth for a seat on the train. There's a 19-year-old kid, Leandro Iskpicher, quoted in the local press saying, giving up a little bit of growth for a Switzerland that's livable for its population is worth it. Giving up a little bit of growth. That is the most dangerous sentence in economics. Because in a globalized world, you don't just give up a little growth. You usually trigger a cascade of unintended consequences. This isn't happening in a vacuum. The timing couldn't be worse. Switzerland is currently trying to navigate a world that is becoming increasingly hostile to its brand of neutrality. The US, under its current trade policies, recently slapped a 39% tariff on Switzerland. It was a warning shot. They negotiated a temporary truce in December, but the message was clear: pick a side. Switzerland resisted joining the UN until 2002. They refused to pick sides in wars for centuries. But when Russia invaded Ukraine, the pressure was too high. Switzerland adopted EU sanctions. This infuriated the traditionalists in the SVP party, who see it as a betrayal of Swiss values. So you have this perfect storm. External pressure, the US and EU are squeezing Switzerland to align politically. Internal pressure, the voters want to close the borders and return to a nostalgic version of the past. Cedric Wermuth, a leader of the Social Democrats, put it perfectly: Beijing, Moscow, Washington are just not reliable partners. There is no alternative to close relations with Europe. He's right. Geographically and economically, Switzerland is an island in a European sea. If they build a dam to keep the Europeans out, they might just drown themselves. But logic doesn't always win elections. We saw that with Brexit. We saw that with the rise of populist movements across France and Germany. The emotional argument, take back control, is incredibly powerful. And let's be honest, the grievances are real. If you are a bike shop owner in Zurich, like Roland Meyer, seeing the forests disappear to build condos for Google employees, you don't care about UBS's stock price. You care about your neighborhood. This is the gentrification of a nation. So, where is this going? As an investor, you need to game plan this. I see three scenarios playing out over the next 12 to 24 months. Scenario A, the suicide vote. The initiative passes. The Swiss government is legally bound to cap the population. They notify Brussels. the EU triggers the Guillotine Clause. Market impact, the Swiss market index crashes. Companies like Nestle and Roche face massive uncertainty. Currency, the Swiss franc initially spikes then crashes as the long-term economic outlook darkens. Your move, this is a shorting opportunity for Swiss equities, but a buying opportunity for US competitors. If Roche can't operate, Pfizer and Merck win. Scenario B, the messy compromise. The vote is close, or the government creates a counter-proposal. They don't put a hard cap, but they implement strict quotas and new taxes on foreign labor. Market impact, slow bleed. Multinationals stop expanding in Switzerland. They open their new AI research centers in London or Silicon Valley instead. Economic impact, Switzerland enters a period of secular stagnation. High costs, low growth. It becomes a beautiful museum, nice to visit, bad to invest in. Scenario C, the tech exodus. The vote fails, but the sentiment scares away talent. The brand of Switzerland changes from open for business to closed to foreigners. The brain drain, the smartest engineers and financiers simply choose not to go there. Why deal with hostility? Result, a gradual decline in Swiss competitiveness. We are living in an era where politics is eating economics. For 4 years, from 1980 to 2020, the logic was simple: globalization brings growth. Open borders, free trade, efficient markets. Now, the pendulum is swinging back. Sovereignty is beating efficiency. Identity is beating GDP. Switzerland is the canary in the coal mine. If the richest, most stable, most sensible country in the world decides that it has had enough of globalization, that implies the trend is unstoppable. If this passes, it sends a signal to every populist movement in Europe and North America that isolationism is a winning strategy. So, what should you do with your money? 1. Check your exposure, look at your international funds. How much weight is in Switzerland? It's often the second or third largest holding in ex-US funds. Be aware of the risk. 2. Watch the franc, it has been the ultimate hedge against the dollar. If the Swiss political system destabilizes, that hedge is gone. You might need to look at gold or short-term treasuries as an alternative safe haven. 3. Follow the talent, if Switzerland closes its doors, that high-skilled labor has to go somewhere. This is bullish for tech hubs in the US, the UK, and emerging hubs like Singapore. The vote is coming. The anger is real. And the mountains are closing in. In the 20th century, Switzerland got rich by being the world's bank. In the 21st century, they might decide that being rich just isn't worth the hassle anymore. And if they cash out, make sure you aren't left holding the bag. Thanks for watching. If you want to know which specific US sectors benefit if Swiss pharma collapses, check out the link in the description for my deep dive report. Don't forget to like, subscribe, and hit the bell because the global economy doesn't sleep, and neither do we.